All right, Darren, I think we'll go ahead and get started. Hello, everyone. My name is Alyssa Barry, and with me today is Darren Marble, co-founder and CEO of Issuance. We're pleased to have you on our second webinar, The Future of Online Capital Raising. We've got a lot of really exciting things to talk about today. Darren has extensive experience supporting companies through their journeys of Reg A's, Reg D's, Reg CF, and on to going public. Darren is going to share with us today the latest trends in tech and how to position yourself for success in the current market environment. We'll have Darren kick things off, and then I'll be happy to hop in on the back end to talk a little bit about marketing and investor relations and to provide a little bit more perspective there. And with that, I'll now turn it over to Darren.
Thanks, Alyssa. It's so great to be back with you on this webinar, and literally down the street at Pac Rim here from my hotel. I was here for the Gravitas Securities Conference. So I love the city of Vancouver. Great to be back. And thank you, everybody, for joining this webinar. We're going to keep it short and sweet. I just want this to be kind of a highlight reel, high-level market update. What are the trends and opportunities we're seeing in the online capital raising industry, strategies for success, risk mitigation, marketing, all of it. And thank you again to not only Alyssa, but to the irlabs team for helping us market this webinar. So I'm going to pull up the deck here and we'll go through this pretty quick. All right, so this is the market update. There's kind of three key stats, Alyssa, that I wanted to open with just to frame the conversation. We're kind of in the middle of Q1 2023 and what's happening in the online capital raising or equity crowdfunding space. Well, here's a summary. So there's 3 Jobs Act exemptions that are kind of top of mind when a company thinks about raising capital online. There's Reg D 506C, Reg A+, and Reg CF. Reg D is something I actually want to highlight today because it happens to be the biggest exemption relative to how much capital companies are raising under Reg D 506C. But interestingly, it's also the least talked about exemption because that particular exemption is focused on accredited investors. In fact, you have to be a verified accredited investor to participate in an issuer's Reg D 506C offering. So with that framing in mind, and these stats for Reg D and Reg A, Alyssa, are roughly from July 2021 to July 2022. So in that 12-month period, issuers raising capital under Reg D raised almost $150 billion. So it just really, it's the outsized exemption. It really trumps the capital that's been raised under Reg A and Reg CF, which is why I want to highlight it. So 150 billion raised July 21 to 22. Reg A+, which is the exemption I'm probably most passionate about, same time period, companies raised about 1.8 billion. And then Reg CF is, what is really known as true equity crowdfunding. Companies raised almost $500 million. The Reg CF numbers, by the way, are for the year of 2021. That data is from King's Crowd. The other two are from an SEC report. Couple other important points to note. The median raise under Reg D 506C is just under $1 million. It's about 2.2 million under Reg A+. And then I do want to point out that for the first time ever in the history of the Reg CF industry, the market declined. The amount of capital that companies raised from 2021 to 2022 declined about 10%, which shouldn't be a surprise to anybody given the market turmoil, all kinds of finance factors, economic factors. First time it's declined in the history of the industry, but there's hope. And if you look at what's happening month to month in the last 60 days, in January of this year, Alyssa, Reg CF issuers raised $23 million, average check of about $1,100. And then you see an uptick. The funding for March was $34 million with an average check almost $400 higher, $1,400 average check. So that's just kind of a gut check where the market is, the amounts of capital that are being raised by issuers using Jobs Act exemptions. And it looks like we're at the beginning of a recovery. So we're very bullish in terms of what the outlook will ultimately look like for 23. And I want to talk for a minute about, Reg D, because this is an exemption, Alyssa, that we really haven't been doing a lot with until recently. And in the last 30 days, Issuance has actually doubled our pipeline we've literally doubled our pipe with these deals. And I want to explain why that is and why we're seeing more and more companies in the US and Canada that are both private or public companies opt for a Reg D 506C capital raise. So this is a capital raise tool that's available to US and international companies. The issuer can generally solicit or market the deal, and yet you're limited to accepting verified accredited investors, okay? So you can market, you can solicit, but you can only accept accredited. The reason this exemption has become so popular is because the companies don't need an audit in order to launch. You don't need 2 years of audit. You don't need reviewed financials, nor do you need a lengthy filing with the SEC. So, you could actually launch a campaign with a platform contract with Issuance, a subscription agreement for the offer, and a landing page and a campaign from irlabs and launch tomorrow or next week. In other words, it's so quick, easy, and cheap to launch. Every company that is thinking about raising capital online, I think, should do one of these campaigns. Now, this is not going to be a $25 million blowout. Again, the median capital raise is just under $1 million. So for context, the companies that are coming to Issuance that are looking to do these 506C raises, they're looking for $1, $2, $3 million. And any company that's doing a Reg A, that's waiting to complete their audit, waiting for the SEC to review or qualify the offering circular, those companies should do a Reg D 506C right now. They should do $1 million round, text out the landing page to their existing shareholders, their network, their friends and family, because you can market the deal to anybody. You're just limited to accepting verified accredited investors. And what we've done on the software side is we've actually streamlined the investor verification process. We've gotten the process now faster than any platform in the industry. And that's really where the friction point is how the platforms verify that investors are in fact accredited. But again, I wanted to highlight this because it's a $150 billion market, and there's just so much capital being raised by companies that can really launch these campaigns in a matter of days and just go. So I think it's a really exciting new way, technically not new, but interestingly, most companies are not aware of this exemption. They hear about Reg CF and a platform, and they want to turn the customer into an investor. That's all good and great, but this is something that every company should know about.
Darren, just a quick question on that. With focusing on accredited investors, and I love that you've been able to streamline that verification process. If we've got investors coming that are not accredited, is there a way with the technology to allow us to capture those individuals in case we do want to target non-accredited investors later on?
It's a great question, and the answer is yes. So in our workflow, if an investor selects accreditation, they are accredited, then they go through the accreditation verification process. If they say they're not accredited, then that investor can be asked for their first name, last name, email, phone number, how much they would invest if they could. And so the issuer is able to effectively build a lead list, which they can then use and repurpose for an upcoming Reg CF, an upcoming Reg A+. Therefore, if they're spending any kind of capital on marketing, they can gain the value of those marketing dollars by building a lead list for the non-accredited. So very easy to do, very common. There's a fork in the funnel. You're accredited, great. You continue with the investment, you go through verification. If you're non-accredited, you get added to the wait list. And hey, this company may launch a campaign in 2, 3, 4 months. You'll be first to know. So absolutely. So I want to hit a top 10 list. We're talking about, the future of online capital raising, and I think it's a very bright future. These are strategies for success, and these are kind of the themes I wanted to highlight here. So this is my top 10 list. These are opportunities, they're trends, they're things that companies raising capital online in the US and Canada should be aware of. The first is to know your options and plan accordingly. All this means, Alyssa, is that there's these 3 capital raising tools. You're not going to use them all at the same time. You really need to understand what type of online capital raise is best for your company. If you are an early stage startup, you are launching an app, and it's going to be a travel app, but you have no users, you're not a fit for a Reg A+. You don't have a community to go market your investment to. You should do a Reg D, right? If you've got a semblance of a community, but you don't have hundreds of thousands of dollars to tee up, the offering circular with the SEC, you might want to do a Reg CF. So it's important that companies understand the pros and cons of each of these online capital raising tools, how they work, and very quickly determine which tool is right for them. So what we're seeing a lot right now is a company starting with a Reg D 506C, moving into a CF, and then graduating to an A plus offering in success. Because again, the D is the fastest, easiest, cheapest way to launch, fastest time to market. Use that capital to fuel the CF and onward. 2, plan to pay a higher cost of capital in any deal. Heads up, raising capital online is not cheap. You might pay 15 to 20% cost of capital. Why would a company do that? Why is this industry roughly growing 100% year over year? The reason is because founders set terms. Okay, so there's pros and cons to that concept, but that is what's driving the growth of the industry. So companies are generally willing to pay a higher cost of capital in order to effectively retain greater ownership and control of their business because they're setting terms. But be prepared to spend a higher cost of capital to raise online. 3, you're always responsible for your marketing. Again, reality check. You have to market your deal, period. Okay, most of these deals are not brokered. Equity crowdfunding platforms are not investment banks. There is no traditional placement agent calling a book. The founder and CEO needs to take responsibility for marketing their deal. They need to come up with a campaign to market their securities to their own community or bring in a credible, polished firm like irlabs and allocate budget to go run the campaign. But the founders are responsible for marketing. 4, you need a best of breed solution, not a fully integrated solution. Been thinking a lot about this. There are a lot of platforms in our industry, Alyssa, that have broker dealers, transfer agents, marketing firms. Honestly, I don't think it makes sense. Capital markets to me are like a hospital. You go into a hospital and God forbid you get heart surgery. You don't want the heart surgeon performing brain surgery or any other type of surgery. You need a specialist. When you have a platform or a broker dealer that also does 3 other things, something is suffering there, right? These are totally disparate functions. The most successful companies in this industry are using best of breed partners, the best platform, the best marketing agency, broker dealers, kind of agnostic, transfer agent agnostic. It's an easier way to raise capital than finding a firm that says we do it all. If it sounds too good to be true, it is. So what does this mean? I hear this every week. Company comes to me, well, Darren, I talked to XYZ platform and they just raised $7 million for a company down the street. And they said, if I sign up with them, I could probably raise $7 million too. That sounds too good to be true, and it probably is. And you may be taking on an unknown, unquantifiable risk to work with a platform or partner like that that says, this is easy. We've done it here, here, and here. None of it's easy. Now, there are tricks, there are cheats, there are hacks, but you have to be very careful in this industry. This is a highly regulated industry. It's no easier raising capital online than it is in a private placement, venture, broker deal. If somebody's telling you it's easy, you're probably the sucker. So just be careful. Target multiple investor types. This is where a firm like yours, Alyssa, irlabs comes in. If Issuance is a platform and the issuer is targeting accredited investors or non-accredited retail investors, how about supplementing that by targeting institutional investors, right? Target multiple investors to increase your likelihood of success and to increase the odds that you raise more capital. Don't just focus on the retail investor. Partner with firms like irlabs that can bring institutional investors, family offices. What if you got a $5 million family office investor and another 3 or 4 million from retail? That's a great approach to the market. So just don't focus on one type of investor. Think about syndication. Think about ways you can target multiple constituencies through partners like irlabs. Focus on platform and marketing. These are the 2 most important factors in success factors in the online capital raise. So why is the platform important? Platform is important simply because if you have a checkout process that's 3 to 4 minutes, you're going to get a lot of drop off. You're going to get a lower conversion rate. You're going to have a lower return on ad spend and a higher cost of acquisition. You're looking for a platform like Issuance where the checkout time is about 40 seconds from click to invest to signing the subscription agreement. At Issuance, our vision is a one-click checkout for securities. We want to make it dead simple for an investor to get from start to finish so that if you're allocating a $250,000 marketing budget, you're going to get higher conversion. And then the marketing. The name of the game is retail distribution. You have to take responsibility for your marketing. You need a marketing budget. You need a marketing partner. Those are really the most important factors in the deal. Spend your time there. 8, launch by announcing a closing. This is a brilliant strategy we've seen executed very recently by a number of successful issuance clients. Rather than say, we're out to raise $20 million and keep it open for 6 months, you say, we're announcing that the dollar round is closing in 30 days. Did you hear that? We're announcing the dollar round is closing in 30 days. You launch by announcing a closing, and then you close the round. Maybe you open it at $1.20 on day 31. So you're immediately, pushing urgency and limited time and limited allocation versus saying we're out to raise 20, 30, $40 million and we're going to keep this open for a year until we get there. You can tranche the raise. The most successful issuers in our industry are doing multiple price per share increases over a year. 9, get a third-party valuation report. So this is I think, not talked about enough topic. Company goes out and says, we're worth $50 million. Really? Why? Because the founder said so? Well, what if the founder said, we got a third-party independent valuation report that values the business at about 65 million. Here's the bottom-up, top-down analysis, and we're offering shares at a discount to the third-party valuation report. That's compelling. What's it going to cost? 10, 20, 30 grand. But if you're trying to raise millions of dollars, that might be the smartest money you spend outside of the marketing dollars. A third-party valuation report that you can point to drive credibility, to substantiate the valuation of your deal. This firm said we're worth 65 million. It's not just me. And last but not least, hire a good securities attorney. This is a regulated industry. When you're promoting securities, you have to do it compliantly. So founders say, well, here's my landing page. What do you think? We are a platform. We're not your securities attorney. Hire a securities attorney and pay them to tell you what they think of your landing page. Is it compliant? Is it fair and balanced? Is it too promotional? Are you missing disclaimers, disclosures, assumptions? The securities attorneys play a critical role in this industry. If you're looking for guidance or recommendations, you can ask me, and we've got a plethora of phenomenal securities attorneys we work with. That's my top 10 list for success for 2023. And with that said, Alyssa, I want to turn it over to you because we've just talked about how critical the marketing is to the success of these deals. I think the first question I want to ask Alyssa is this: how do companies stand out in this market? It's a crowded market. So many companies are looking to raise capital. How do they stand out? What should companies do?
Thanks, Darren, and thank you for framing that for us. I think that was a really helpful update. I love the work that's being done on the Reg D side right now, and so thanks for walking through that. And thanks for covering off some of the really important components there as well in your top 10. To stand out, I think one of the perhaps misconceptions often in the online capital raising space is it operates much like the public markets in that if you get listed on the New York Stock Exchange, the Toronto Stock Exchange, whatever it may be, investors aren't going to just naturally find you. We hope that through performance and through visibility and some word of mouth and momentum, investors will find companies. But similarly with the private markets, there needs to be a marketing exercise. It serves as, think of it as the exchange where you need to drive visibility and traffic ultimately to be able to have investors convert. So I think the biggest thing in this market, and I would say we're in a really great market, I think, right now for the online capital raising space. I would argue in some ways we've been very saturated the last few years, but I would say the deal quality that we're seeing today is really impressive. And I would say a lot of the deals that we're seeing are just standouts alone, but it's really getting that story right and coming across very authentic. I can't emphasize enough how important it is to be clear and concise in your communication, and investors should be able to arrive at the landing page and really within, I'd argue that 30 seconds or less, know what you're all about, at least at a very, very high level. And it's building that storyboard as well. I love what you said about coming out and we're going to be closing. I think having a little bit of a little bit of that deadline is really, really nice. And I've seen some really great success around that too. And then having a really clearly defined roadmap of what other stories you're going to be telling investors to create that FOMO leading up to that 30 days or 60 days. You mentioned fans and followers and having a community. That is really important too. And it's an untapped market for a lot of companies. We often sit down with our clients, and the first thing we say is, who do you have in your network? Not because we want our jobs to be made all that easier. We just want to make sure we don't lose that opportunity for all of the work that has been done from a brand building perspective that already got the company to where it was. Let's make sure that those individuals feel the love, know that there's an opportunity for them to participate or perhaps increase their investment, and just build upon that.
Alyssa, can you dive into for a minute what you mean by authenticity? How what does that mean? Like a founder to be authentic in a marketing campaign or an online capital raise, and I want to hone in on that a little bit more.
I love getting the stories behind the companies themselves and really understanding the founders and getting to know the founders and the visionaries. I very shortly in my career, I had a 5-year pivot where I became a shareholder activist. And the really big thing for me, or the learning, was making investments with very, very solid management teams. And I think that is absolutely critical. I think investors want to know who's behind this, and is this the right team that's going to guide us to the finish line? And it's all nice to see a video is great. A corporate video with some voiceover is nice, but I'd much rather interview our founders and hear, why are they passionate? Why have they built this?
Right.
And feel their ambition come through. They're the ones that are going to ultimately be guiding the future of this company. I want to connect with the founder.
I love it. And then can you give us some examples, Alyssa, of easy wins? What are easy ways for companies raising capital to gain investors? And also, what are some of the mistakes you've seen along the way?
Sure. I think we've touched on some of the easy wins. The fans and follower piece is really critical, making sure that you've got a really great story. Often, I think sometimes if companies are trying to save money on the marketing side, I can completely appreciate it. And as an entrepreneur myself, the more that I can do myself to save myself some dollars, I totally get it. But sometimes we see the writing come through very academic, or it's just not, connecting with the investor audience at the end of the day. So making sure you've got really great copywriting. The earned media is a really big one. It is very hard to get earned media. And as the word earned says, it is earned. So I often, when someone says, can you get me in the media? I said, sure, I can guarantee that. And it's called advertising. But I really want to put best efforts forward to try and make sure that we've got organic earned media. So putting together really great pitch points, we leverage our PR team to help our clients with this. And, how great is it if in your industry trade publications, newsletters, or even in the financial media, if you can get that coverage and sharing that with your followers. Podcast opportunities are part of that. We are pitching our clients to different podcasts that have distribution lists themselves, or broad distribution that could ultimately drive traffic to our landing page that you spoke about. And there is often a missed opportunity. So discussing the mistake side of it, often for companies that are maybe sort of new to the game or haven't developed that very comprehensive marketing program or roadmap, we get all this coverage, but it doesn't bring any momentum. And usually in that circumstance, that, call it Wall Street Journal, I'm being very ambitious here, article that has been published, you've got the readership of Wall Street Journal, but there's also another community that you're trying to build at the same time, and perhaps some existing fans and followers that are on your distribution list, sharing this information with them, whether it's through your email campaigns or social media. You mentioned mistakes, bad pitch decks. I can't tell you the number of pitch decks, and I usually read about 10 a week that I'll mark up and provide comments back to our clients or those who just want an extra set of eyes. I get to the end of it and I still don't know what the opportunity is. I shouldn't have to know everything about it, but making sure that it is clear what is the opportunity? Why is this the best opportunity for me today as I put my investor hat on? And how is this company going to make me money at the end of the day? So that really needs to come through very clear. And you mentioned the landing page. I often see too many clicks. We want to try and eliminate as many clicks as possible to get the investor to click on the Invest Now button. So that's something where I think it's really important to think about if you're directing and spending significant ad dollars, whether it's on a Google ad campaign, a Facebook campaign, whatever it may be. Are you driving people to the right place, or are they having to go click and maybe a few more times to get to that Invest Now button? That's those would be sort of the key mistakes that come to my mind.
Thank you. Those are all great pieces of advice. Moving on, can you talk a little bit about, Alyssa, what happens after an investor onboards with the company and what's next?
Yeah, really great question. And this is an area that I get really excited about. That ongoing communication is absolutely critical. So once an investor converts and becomes an investor, money is in the bank, they're on your cap table. That is a moment to celebrate. But it's making sure that that ongoing communication comes. Reporting, news flow, updates. We can't forget about the investors who got us here at the end of the day. And that is something that is overlooked because it is that extra effort and time and budget to make sure that those investors feel the love. I represent a lot of public companies as well. And one of the things that we often see is that cap table of investors, whether it's 500, 5,000, or even greater, those investors one day are going to want an exit. They didn't invest to be by our sides forever. We hope they're along for the journey until they feel that they're getting full value for their investment at the end of the day, and we'll continue to excite them so that they'll be along for the journey for a long time. But we need to make sure that they believe in us from before they become an investor, when they become an investor, and on an ongoing basis. And poor communication, lack of transparency, lack of updates, that could really cause distraction to management because we're going to be fielding questions about that. But we want those investors to stay with us if we are going public at some point. We don't want day one of on the NASDAQ or the TSX, seeing those investors sell out. And in some cases, even at a discount, because, this was something I invested in 5 years ago.
Right.
I just, maybe I've lost money in other places. I want to offset. I just want to get liquidity. So I think really spending time with those investors, investor days, investor calls, something like this, which is so easy for us to put together today, being able to create that environment for your existing investor base is critical.
And out of curiosity, Alyssa, what's like a proper cadence? Is this something, post listing or after a close of an online capital raise, monthly, quarterly, somewhere in between?
I think the more the better, but there is a balance because once you start, you set a precedent. So I do, while I tend to be an over communicator myself, I often say whatever we set as the bar, we need to make sure that we maintain that. A monthly update on how things are going is kind of nice. It doesn't need to be a big academic exercise. I would suggest that often you get legal advice to just have a quick eye on something, especially if you're new to communicating to investors. You don't want to end up in a situation where you've promised something, maybe inadvertently through the copy that you've written. Video updates are really easy to do as well. And I would say even just picking up the phone and filming a quick 5-minute update video and having that just vetted by investor relations, your legal, and being able to share that more broadly. These webinars are really nice too, to be able to pop in quarterly or at least once a year and check in with your investors. So I think it depends on how many investors you have as well, Darren. So if you've got 50 investors, maybe they've all been sort of that Reg D, larger check size. Maybe your communication needs to be a little less frequent versus if you've got 5,000 plus investors in your database.
Sure. And we talked earlier about, Alyssa, kind of the state of the market, and you saw that the average check size in a CF deal in January was 1,100, and then February last month it was 1,400. But those are still small check sizes, and the truth is, it's hard to raise millions of dollars, $1,000 at a time. And then I also mentioned in my tips that founders should think about ways to target different investor constituencies, different segments of the market. And in addition to targeting retail, how about trying to go for a 250K or 500K check? That's a game changer. And you add a couple of those together, now you're kind of in the game. What are the strategies that your team has seen successful to help founders secure those bigger check sizes that are really making a difference in these capital raises?
Yeah, great question. Everyone wants the big check size, and hallelujah, it makes things a lot easier for everyone when we can get those. So first of all, I'll say we have to be compliant. So you need to make sure that your with legal advice, we're making sure that we're not soliciting and we're on side with any sort of reach out that we're doing to investor groups. I would say first things first is house needs to be in order. Those larger check sizes are going to require due diligence. They're going to want to date you for a while. They'll want to get to know you. It is really nice when you do bump into someone at a conference or an event, and maybe they're with a family office. They love your story and they expedite the process quite quickly because they have capital to deploy in your space. They like you as a founder, which is great. And I've seen those. I had a situation with one of my clients that happened yesterday, so that was really nice to have. But on the flip side, you really need to make sure that your data room is strong, that you're prepared to answer their questions and share the financial model. Making sure that that is all set up is really critical. And I know that I will not reach out to my community unless I know that that is all in order for our investors. But there's a really great opportunity, and especially now that everyone is out and the world has opened up again, there are some really nice conferences, family office conferences, industry-specific events where investors are there, and just putting yourself in those situations, and you never know who you can bump into. I think LinkedIn is an untapped opportunity for a lot of people as well. Being a founder or CEO, to be able to provide those updates and comment on your business, of course, be compliant in what you're posting. You never know who will see your posts as well. And I've seen a lot of companies, a lot of funds over the last little while who there's so much capital on the sidelines and they're looking for something very specific. So always think about in your communication, trying to write to that group or communicate to that group. And certainly our team can help navigate through all of that.
I love that advice. I think you're spot on about LinkedIn and social media and engaging people. What I've noticed on those platforms, Alyssa, is that there's a lot of people that might follow you or are connected with you that will actually never talk with you, but they are watching you. They're following your story. They're consuming the content. And then if they like what they see, they strike, right? And so you're always being watched. People are following you whether you realize it or not. And then when you see that engagement, that's the opportunity, to convert and cultivate that relationship. And then the other thing you mentioned, which I also think is a sleeper opportunity, is conferences, right? It's post-COVID. People are out. There are people at conferences. There are investors at conferences looking to deploy capital right now. We have a client, Alyssa, in Washington that's raised $20 million at conferences. And so the funnel is the conference. It's the booth setup. It's the people that are staffed at the booth at these conferences, and they exhibit every 30 days all across the United States. $20 million raised at conferences. So you can have your online funnel, you can have your offline funnel. So I think these are things founders really need to think about in these capital raises versus just trying to go run a digital marketing campaign and bring people to a landing page. That's one way to do it. What are the other ways to do it? Content marketing, LinkedIn, Twitter, etc., conferences. I think these are brilliant strategies. And then lastly, before we go into the Q&A, Alyssa, you run an IR firm. You help companies go public. For all of these private companies that have raised capital and are looking at the potential of going public, Can you talk for a minute or two about that journey and what companies should consider to really, prepare and get themselves ready?
Yeah, really great question, a very heavy question as well. So we talked a little bit about having the house in order, and those are certainly things that you're going to need to have to be able to go through that go public journey. There are a lot of questions to be had or discussions to be had about what is the best path, what is the best exchange, who are my advisors that I need to bring in, am I bringing in an investment bank, am I doing a direct list? There's so much that goes into making those decisions, and timing is everything as well. I would say from start to finish, if someone is going down the go public path, I would say set aside sort of 9 to 12 months to plan for that. It really is going to take time to think about process, to think about that team of advisors that's going to support preparing all the documentation, going through the process with the exchanges. I think it's also really important to make sure that that value proposition is truly there. Of course, hopefully at this point, we've raised 20 million, 75 million, maybe even more. And we're ready to go public, and we've already closed, and we've got a great group of investors. But maintaining that value proposition, timing is everything as well. I would say there have been so many companies that went public way too early over the last couple of years, and it's been very challenging for them to continue raising capital in this environment. There are some companies that can hardly keep the lights on some of these venture exchanges right now. They went public with a couple $1 million that they raised, and they with the expectation that the public markets are going to continue fueling that growth. So making sure that capital is set aside for, I'd say, at least a couple of years of runway to be safe. I do believe that we're entering into a far better market, and we're starting to see a lot of deals get done today in the public markets again, which is nice. And then I'll touch on the governance piece for a second. I do have quite a few clients who are private that have put together the governance structure where they have advisory boards. And one of my founders puts it really nicely. His advisory board is an opportunity for him to sort of date his board before he goes public and decide if that's the right board for him when he takes that next step. So surrounding yourself with really great advisors, making sure that your governance is really strong, that will fast forward or fast track you very successfully in the public markets.
Fantastic. Excellent advice, Alyssa. This has been a fun conversation. And I'm curious if we have any questions from people watching that we can answer.
Okay. Question here, Darren. From the time that someone signs with Issuance and wants to get up and running, realistically, what does that look like?
So on a Reg D campaign, if you had your landing page and a subscription doc, it's 20 minutes. So, I'm a believer in, using technology to automate two things. One is to allow an investor to buy securities in a company in under a minute. Again, we've got the checkout time down to about 40 seconds. Google Pay, Apple Pay as checkout methods, a vision for a one-click checkout on the investor side. But we believe in applying that technology equally to the issuer. And we have a vision for a self-serve model where at some point an issuer can go to issuance.com, pick a package, launch a campaign themselves, and go. The same way you sign up for Slack or Shopify, we want to remove the people from the process. These platforms, companies like Issuance don't need 150 employees. I want to have 15, call it a day, and use the technology to automate the investing process, the onboarding and launching process. So in a Reg D deal, it's a 15 to 20 minute process to launch your offering. Now, if it's a Reg A deal, there's a bigger process. You need your audited financials, an offering circular filed and qualified with the SEC. If those things are accomplished, it's then 20 minutes, right? So it depends on the type of capital raise you're doing.
I'm going to just weigh in there that I love the speed at which that functions, and your team is really good at onboarding. I know from experience in collaborating with you. On the marketing side, allow yourself a runway. Those landing pages will not be built overnight. They can be built relatively quickly, but there is that process, as you mentioned, Darren, the compliance and making sure that we've got the messaging right, we understand the story, and that legal has had eyes on it as well. So just making sure that time does get baked in. And you want to make sure that the airplane is almost fully built as you're starting to fly it. Maybe there's a little bit that comes at the end, but making sure that you do have that pipeline of communication, content, and all of that created before you go live.
Absolutely.
Okay. So what's the question, Darren, around cost? Is that something you can speak to?
Yeah, absolutely. Look, one of the things that I've been critical of this industry, my industry, is that platforms charge fees, Alyssa, as if they're raising capital. And to me, it's a crime and it needs to stop. So let me explain what I mean. Typical marketplace or listings platforms will charge an issuer 7 to 8%. Okay. But really, they're not capital raisers, they're processors of investments. So I view Issuance as a processor of investment. I never raise my hand and say, I raised $60 million for my solar electric car client, Aptera. No, Aptera raised $60 million and Issuance processed those investments from 15,000 investors. Why should my firm charge that company 7%, right? Or fees that equate to 7% in a deal where the client is effectively turning their customers into investors? In other words, the company's already paid to acquire those customers. Or if a company's running a campaign, Alyssa, and they're spending $500,000 in an ad campaign, why should they pay a platform 7 or 8%, or fees that total 7 or 8%? Issuance fees are going to range from 3 to 5%, not as a success fee, but as processing fees on credit card, ACH, wire investments, monthly license fees. If you go to express.issuance.com, you can see our pricing. It's fully transparent. There's no hidden fees. There's a minimal onboarding fee, monthly license fees. The fees net out to 3 to 5% for Issuance as a platform, which is really a 30% discount to the market. So I don't think this industry is going like race to the bottom, but I think the days of platforms charging 7, 8, 9% are over. You should not pay a third-party platform 7 or 8% to turn your customers into investors. I have a friend and colleague who raised $20 million, Alyssa, paid the platform $2 million, 10%, and that's just the platform fee, paid out $2 million, and the distribution of the deal was secured by the client, not the platform. So that's $2 million wasted. So those days are over. So Issuance fees are transparent. Express.issuance.com. You can see them right there.
Thank you, Darren. And I'd say on the marketing side, it really is going to depend on what our goals are and whether we're coming in to help with sort of a light support, or whether we're doing a very, very aggressive campaign. Maybe we're raising 75 million bucks and need to have digital marketing, video. There's a lot that can be done without the big production, and we try and make sure that it is as cost effective as possible for our clients. As I referenced, the earned media, yes, it takes effort, but when you get that, you have the potential to save a lot of money as opposed to being in a lot of newsletters or pay to play. But there's that component of it that sometimes needs to come into play as well. And one of the, as I kind of digress myself, one thing that is really important that I didn't touch on, and I do believe that it's important to reference, is just how important it is to have that TLC or personal touch with investors. So we want to automate, and Darren, you guys do an amazing job on the tech side. Once that investor gets in the pipeline, often someone will start making their investment. Maybe they have to go feed the kids or do something else, and they'll have to come back to it later. And if we, on the investor relations and the marketing side, can reach out to that investor and help get them to the finish line, that is certainly a role that we often play. There are some companies that bring in very big call centers to actually run that, depending on how intense it is with the number of people captured in the process. But that's certainly an area where how nice would it be to have that personalized email or phone call of, hey, look, I saw that you're interested in this investment. What can we do to support you? And let me know if you have any questions. Or do you want to meet with the founder? A lot of founders love talking to their investors, big or small. So that's something just to keep in mind as well. Question here, and probably directed to me, making reference to timeline and runway. What does a reasonable time frame look like, or does it depend on the industry? I think it depends on the scope of work, certainly. If we're starting from scratch with building, sometimes polishing pitch decks, maybe even building them ahead of time, landing pages, all of the content creation, drip campaigns, loading your existing contacts into some sort of central system, creating all that social media content, it can take a couple of months to build that out. We have been able to do it much quicker, and we have an incredible team on our side that oversees that. But certainly, I would give yourself a couple of months to make sure that that is all set. That when you launch and say you've got 30 days to close, you really have 30 days because everything has been created and you've got, I call it the 1-2 punch, everything keeps coming out in sequence, which is really good. Okay. Question about, Darren, what is the worst deal you've seen? And maybe don't name that specific deal, but maybe talk a little bit about what went wrong in that situation.
Man, that's a good question. I don't know if I have a worst deal, but I would say that, the criticism of this industry, Alyssa, from certain traditional venture capital firms, institutional investors, certain funds and groups on Wall Street, is that valuations in these deals are out of whack, right? And that because founders can set terms, they're taking advantage of that. And they are, in fact, assigning themselves valuations that are just unsubstantiated. They're not based in reality. And to an extent that is true. There are founders that push the limits. And I've heard people say, well, these investors don't know any better. And I cringe when I hear that. It pains me because those are not the right people to be teeing up a campaign. And the reality is if those founders raise capital at an absurd valuation, they'll never raise capital again from smart money. They're really trapping themselves and their shareholders. And if they ever get public, there's havoc to be wreaked on these deals. And we've seen that. We've seen it in 2016 and 2017, Reg A issuers specifically raising capital at valuations that were just too high, that did not make sense given the revenue or EBITDA profile of the business. And yet they were able to raise capital anyways. So I don't know that I would say there's, a worse deal. But I would go back to this idea of founders looking to validate their valuation through a third-party valuation firm, so that they have something to point to as evidence that they have taken steps to really have this firm dive into the business, look at the historical financials, look at the pro forma, look at the comps. Who are the comps? The private market, public market comps, and then deliver a detailed analysis that the founder can then point to evidence this is a fair and reasonable valuation. So that's my long-winded answer rather than saying, well, this company did this or that. I just think, the valuations, founders need to be sensitive to how they're structuring deals and how they're pricing their deals.
Perfect. Thank you, Darren. Okay, well, I think that takes us right to time. Really appreciate having this conversation with you today, Darren. How can people get in touch with you?
You can email me, Darren, at issuance.com. Express.issuance is our product site, issuance.com for more information about the business. And I'm also on LinkedIn and Twitter and pretty active there, talking about entrepreneurship and strategies for founders to raise capital. And how about you, Alyssa?
LinkedIn is where you can find me, and Alyssa at irlabs.ca, ALYSSA at irlabs.ca. Thank you very much, everyone, for being here. If there's any further questions, feel free to reach out.
Thank you.
Have a great weekend. Take care.